How to use channels for trading decisions. In this video, you will learn what channels are, the different types of channels that exist, how you identify channels, why they work, how you can use them to find trades, and the use of channels in multi-time frame analysis. Whenever the price of an asset is moving within the boundaries of two trend lines, it is said to be trading within a channel. When the price moves up between two trend lines, it is called an ascending channel. And when the price moves down between the trend lines, it is called a descending channel. A horizontal channel exists when price moves in a range. When you want to draw a channel, you look for two tops. A top is the point where the price reached a new high and then reversed. You also need two bottoms to draw a channel, so you look for points where the price reached a low before turning back up again. Then you connect the two tops with a line and two bottoms with a line. You have now created a channel. When in a downtrend, there is no difference in drawing a channel. You again look for two tops and two bottoms. Then you connect the tops with a line and the bottoms with a line. And when the price is moving in a range, you again connect two tops and two bottoms with lines. Channels exist because more and more people start noticing them and use them to trade. So when a price reaches the top of the channel, many people believe that the price will start to fall, and so they sell. Because of all these people selling, the price will actually fall as predicted. Then, when reaching the bottom of the channel, a lot of people will think the price will reverse and go up, hence they buy. As a result, the price will actually go up again. As more and more people observe the channel, the price will move in the channel, because it is essentially a self-fulfilling prophecy. By knowing this, you can take advantage of a channel. There are two ways to do this: trading the bounce or trading the breakout. Let's look at trading the bounce. First, you must have two tops and two bottoms to draw the channel on your chart. Then the next time the price reaches a channel boundary, you open a trade in anticipation of a reversal. So when the price reaches the lower boundary, you buy. And when it reaches the upper boundary, you sell. The safest way to trade using a channel is in the direction of the trend, meaning that you will only enter a long trade at the lower boundary in an uptrend. When you look at a descending channel, trading in the direction of the trend would mean going short at the top boundary of a channel and closing your position at the bottom boundary. In a horizontal channel, there is no prevailing direction, so you can either go short at the top boundary and close your trade at the bottom boundary, or go long at the bottom boundary and close the trade at the top boundary. You can also trade when the price breaks out of the channel. If you anticipate that the price will not reverse at the boundaries, but will continue at an accelerated rate in the direction of the trend, you buy when the price crosses the upper boundary, or you sell when the price goes through the lower boundary. As always, it is best to also do this in the direction of the trend. So in an uptrend, you go long at the breakout of the upper boundary, and you might want to go short at the breakout of the lower boundary. Because there is no trend in a horizontal channel, you can do both. Go long at the breakout of the upper boundary or go short at the breakout of the bottom boundary. Channels can also be used in conjunction with multiple time frame analysis. You can look at the boundaries of the channel on a higher time frame to see when the price is likely to reverse. So when, for example, the price on a 4-hour chart is trading at the lower boundary of a channel, you can look for an accurate entry on the 1-hour time frame and benefit from a tighter stop loss. So far, you have learned that there are three types of channels. In an ascending channel, prices move up between two trend lines. In a descending channel, price moves down between two trend lines. And in a horizontal channel, price moves sideways between two trend lines. When drawing channels on your charts, you identify two tops and connect them with a line. and you identify two bottoms and connect them with another line. You also learn that there are two ways to trade using channels. You can trade the bounce or you can trade the breakout. When trading the bounce, you are expecting a reversal at the boundaries of the channel. It is always best to trade the bounce in the direction of the trend. This means that you go long at the bottom boundary of an ascending channel and go short at the top boundary of a descending channel. In the horizontal channel, you can trade either way. Trading the breakout is also best done in the direction of the trend, meaning that in an ascending channel, you go long at the breakout of the top and go short at the breakout of the bottom. And again, in a horizontal channel, you can trade the breakout either way. Furthermore, you learn that channels can also be used in multi-time frame analysis. On the higher time frame, you look for direction. On the lower time frame, you looked for an exact entry.